Welcome to Iron Financial. Look, our mission on this channel is incredibly simple. We are here to help you forge a stronger portfolio, and we do that by cutting straight through the endless market noise with cold, hard, structural financial analysis. Today, we are putting Palantir Technologies through the ultimate stress test. We're tearing down their Q2 2026 earnings report to see if these explosive, headline-grabbing numbers are built on an unshakable foundation or, if there are hidden cracks in the steel. We are going to look under the hood. We're talking margins, contract lock-ins, cash flow, the whole shebang. If you demand total clarity on your investments and you're tired of the fluff, hit that subscribe button, turn on notifications, and let's get to work.
Okay, we are starting with a metric that, frankly, completely breaks traditional financial models. For the uninitiated out there, the Rule of 40 is basically the ultimate structural test of a software company's health. You simply take their revenue growth rate and you add it to their profit margin. In the software industry, there is this fundamental law of physics. As a company scales up into the billions, it almost always has to sacrifice profitability to maintain its growth or, conversely, sacrifice growth to achieve profitability. Hitting a score of 40% means you've achieved an elite, world-class balance. Well, Palantir didn't just pass the test. They literally took a sledgehammer to the scale. Their Rule of 40 score just hit an astronomical 155% in Q2 2026. This isn't just standard growth we're talking about here. This is a heavy machinery, cash generation engine operating at a velocity we rarely witness in public markets. They are completely defying the gravity that normally pulls down enterprise software companies when they reach this kind of massive size.
Okay, I have to jump in right out of the gate here. Yes, a 155% score is historic. There's no denying that. But as investors, we have to represent the audience here and ask the really tough questions. Is Palantir actively building an unbeatable monopoly in the enterprise artificial intelligence space, or are we just looking at a massive speculative bubble? Because let's be real, the broader AI market has seen countless companies pop on hype and then drop dramatically when the actual tangible earnings fail to materialize. Investors are rightfully nervous right now. The market is pricing Palantir at a massive, massive premium today. We absolutely need to know if this scale is genuinely sustainable or if it's just a valuation trap that's ready to crack under the intense pressure of these sky-high Wall Street expectations.
Phase 1. Breaking down the core financial engine. So, to answer that question of sustainability, we have to drill down into the exact line items. No more hype. We are inspecting the heavy machinery driving the company's top-line revenue to see exactly where this unprecedented momentum is actually coming from. The headline revenue figure for Q2 forms the bedrock of this entire quarter's performance, and that sits at $1.935 billion. That represents a blistering 93% year-over-year growth rate. But honestly, what you really need to pay attention to is the 19% sequential growth from Q1. Let me put my seasoned trader hat on for a second here. Quarter-over-quarter growth of that magnitude, especially when a company is already operating at a nearly $2 billion quarterly run rate, is structurally incredibly difficult to achieve. It's like turning a battleship on a dime. In the enterprise software space, growth almost always decays as the numbers get bigger. It's just the law of large numbers. But Palantir, they are doing the exact opposite. They are accelerating. The financial engine is running hotter and faster right now than at any point in the company's entire history. But we really need to look under the hood to see the exact revenue mix, because a massive structural shift is happening within this company right before our eyes. For years, the major bear narrative was that Palantir was entirely dependent on lumpy, slow-moving government defense contracts. People said they couldn't hack it in the private sector. Well, that is no longer the reality. U.S. commercial revenue just exploded by 149% year-over-year to $764 million. On the government side, U.S. government revenue grew an extremely healthy 90% to $809 million. The commercial business is catching up to the government business at an incredible, undeniable velocity. Total U.S. revenue hit $1.573 billion. That means the domestic market now accounts for roughly 81% of their entire business. So why does this matter to you as an investor? Because explosive commercial growth proves broad market adaptability. It means they are successfully unhooking themselves from the constraints of government defense budgets and aggressively penetrating the massive, fast-moving corporate sector.
Okay, I hear you. The U.S. commercial growth of 149% is undeniably huge, but I really need to push back on the actual quality of that revenue. Is this commercial acceleration genuine, durable cash flow, or is it just fleeting excitement? We all know Palantir has been aggressively running their artificial intelligence platform, or AIP, boot camps. They've been getting hundreds of companies to come in and test the software for free, essentially. So, are these enterprises actually signing sticky, long-term contracts after these boot camps are over, or are they just kicking the tires in trial phase AIP hype? Because let's be honest, running pilots and prototypes might bump the top line for a quarter or two, but it absolutely does not forge a long-term economic moat. That is the perfect question to ask, and the structural proof you're looking for is right there in the forward-looking contract metrics. We aren't just looking at recognized revenue today, we are looking at massive locked-in forward commitments. U.S. commercial total contract value, or TCV, closed at a record $2.132 billion. That is up 153% year over year. But even more critical than that is the remaining deal value, or RDV, in U.S. commercial. That number reached a staggering $6.238 billion, up 124%. Let me break down exactly what that means mechanically for a second. RDV is money that is contractually obligated by the client to be paid, but Palantir just hasn't officially recognized it yet on the income statement because the service is ongoing. It is a guaranteed future cash pipeline. This right here, this is the iron rebar inside the concrete. When a company commits to billions in future spending, they aren't just playing around with a pilot program. These are massive multi-year enterprise lock-ins that secure Palantir's revenue for years and years to come.
And to prove that they are out there doing the heavy lifting in the field to secure those commitments, just look at the raw deal flow breakdown from the quarter. During Q2 2026 alone, they closed 220 individual deals worth at least $1 million. And if you want to drill even deeper into the structural integrity of those contracts, 98 of them were over $5 million, and 73 deals were at least $10 million or more. Think about the gravity of that for a second. Fortune 500 companies do not write eight-figure checks just to play with a shiny new AI chatbot. They only commit capital at that magnitude when the software is literally becoming the central nervous system of their core operations. Palantir isn't just selling software licenses, they are installing foundational operational infrastructure inside the largest companies in the world. All right, I'll concede the top line is clearly forged in steel. The demand is real. But top-line growth is only half the equation in any real financial analysis. It's time to pivot our attention over to the balance sheet. Growth at all costs is a very dangerous game in today's market, so we need total clarity on the actual sustainability of their profit engine. Phase 2. Margins, stock-based compensation, and cash flow realities.
Let's talk raw, unadulterated cash generation. Palantir generated an immense $1.22 billion in adjusted free cash flow in Q2 alone. That represents a 63% margin. Just let that sink in. For every single dollar coming in the door, 63 cents is turning into pure free cash flow. To put that into perspective, in the broader software space, a 25 to 30% free cash flow margin is usually cause for celebration. 63% is almost unheard of. This is exactly where you see the sheer operating leverage of their software at scale. Once the heavy lifting of the initial deployment and integration is done at a client site, the incremental cost of serving that customer drops tremendously, and the margins just expand aggressively, pouring straight down to the bottom line.
And what exactly are they doing with that absolute torrent of cash? They are building an unshakable fortress of a balance sheet. Palantir ended Q2 2026 with $9.2 billion in cash, cash equivalents, and U.S. Treasury securities. But here's the kicker. They achieved this with absolutely zero debt. Nothing. In an environment of macroeconomic uncertainty, inflation fears, and fluctuating interest rates, having $9.2 billion in pure liquidity with zero leverage provides massive structural strength. It totally insulates them from credit crunches. It gives management this massive war chest of dry powder to aggressively acquire new capabilities, invest heavily in R&D, or frankly just weather any broader market storm without breaking a sweat.
Yeah, I'm not letting them off the hook quite that easily. We have to address the elephant in the room that plagues the entire tech sector, stock-based compensation. Look at the margin gap here. The GAAP operating margin is undeniably strong at 47%, which represents $912 million. But the adjusted operating margin, which conveniently ignores certain costs, sits way up at 62%, or $1.194 billion. That is a massive spread. Historically, stock-based compensation acts as a silent killer of retail shareholder value. Tech companies hand out equity to executives and engineers to conserve their cash, but it constantly dilutes the actual value of the outstanding shares. Are retail investors just being quietly diluted behind the scenes here while management gets rich?
See, this is exactly why we never ignore the GAAP to non-GAAP reconciliation on this channel. Let's be highly clinical about this and look at the exact line items. Palantir recorded $265 million in stock-based compensation in Q2. Yes, that is a real, tangible expense, and obviously it is a very substantial number. But here is the structural difference between Palantir today and those cash-burning tech companies from 3 years ago. Palantir is generating so much raw operating income that they are completely absorbing the impact of that SBC. The underlying business is growing significantly faster than the share dilution. They are effectively paying top-tier engineering talent with equity, yes, but the massive value that talent creates is vastly outpacing the cost of the shares being issued. And honestly, this is the hammer that proves it. Even after fully accounting for that $265 million in stock grants,
Palantir's strictly audited GAAP net income surged to $1.06 billion for the quarter. That translates to $0.41 in GAAP earnings per share, which remarkably perfectly matches their adjusted EPS. Wall Street demands GAAP profitability because it accounts for that actual shareholder dilution. A lot of companies brag about adjusted profits while bleeding cash behind the scenes. Not here. Profitability here is structural, it is not a non-GAAP mirage. They have forged real, undeniable margin expansion, proving their financial engine is highly durable even when maintaining premium compensation packages for their engineers.
Phase 3. Guidance and valuation. Okay, the fundamentals are undeniably strong. I get it. But in the markets, strength comes at a price. Let's shift our focus to the future. Is this stock an opportunity right now or a trap? With numbers this explosive, the market expects absolute perfection moving forward. Any deceleration in the upcoming quarters could cause severe cracks in their valuation premium. Are they actually guiding for continued acceleration?
They aren't just maintaining expectations, they are raising the roof. Palantir upgraded their full-year 2026 revenue guidance to a range between $8.150 billion and $8.158 billion. That represents 82% year-over-year growth. More importantly, they raised their U.S. commercial revenue guidance to exceed $3.424 billion. And that mandates a growth rate of at least 134%. Listen, raising guidance mid-year isn't a guess. It means management has total, undeniable visibility into a massive backlog of unannounced deals. They also bumped up their full-year adjusted free cash flow guidance to between $4.5 and $4.7 billion. The management team is signaling absolute structural confidence that demand for AIP is still accelerating.
It's really important we bring in an objective third party to weigh this sky-high valuation against the underlying business. Let's talk multiples for a second. When a stock trades at massive price-to-sales or price-to-earnings ratios, the company has to execute flawlessly just to justify the current price tag, let alone go higher. Morningstar recently analyzed Palantir's economic moat, and they stated, Palantir now has 3 full years of GAAP profitability under its belt. We expect rapid growth and profitability to continue. They acknowledge the deeply healthy financial position and the deep integration of the software, which they literally call America's AI operating system. The moat is deep. The crucial question for you as an investor is simply whether you are willing to pay the massive premium required to own a piece of it today.
Phase 4. The ironclad verdict. Okay, we've inspected the revenue engine, we've stress-tested the balance sheet, and we've measured the valuation risks. It is time to make the call on whether Palantir's structural strength justifies its current positioning in the market. Look, the foundation is undeniably unshakable. $9.2 billion in cash, 0 debt, and rapidly expanding GAAP profitability hitting 0.41 EPS. The heavy lifting of building the AI platform is largely done, and the cash flow is now just pouring in at a 63% margin.
Market skeptic. But here is what you really need to take away from this explainer today. You have to weigh a company operating with an unprecedented 155% Rule of 40 score against a price tag that leaves absolutely zero room for error. The enterprise demand for AIP is clearly not a trial phase gimmick. That $6.2 billion in remaining deal value definitively proves that the revenue is sticky. But at these sky-high multiples, you have to decide your own personal risk tolerance.
Exactly right. So, is Palantir a core, ironclad holding for the AI decade? Or do you wait on the sidelines, hoping for macroeconomic cracks to trigger a pullback so you can buy in at a cheaper valuation? Let us know exactly where you stand in the comments below. Thank you for joining us for this financial stress test. Remember to forge your portfolios with facts, not hype. Subscribe to Iron Financial and we'll see you in the next analysis.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.